Hello, everyone, and welcome to the January 2025 edition of Macro Microscope. This is the first of the year. And today we are going to cover what I think is a very important topic, a sign of a changing world. So the exact topic we are going to cover is valuation re-rating of emerging markets. I am Indrani Day, Head of Global Investment Research at FTSE Russell, the index business of London Stock Exchange Group. And I'm joined by John Tufus, Director, Data Stream, also of London Stock Exchange Group. Now, very quickly, as always, the compliance disclaimer that FTSE Russell is not an investment firm, and everything said in this presentation is purely for education purposes, not to be taken as investment advice. And with that, let's jump into the actual data. So the way we are going to cover it today is I'm going to look at the financial markets aspect of the valuation re-rating of emerging markets, covering across different asset classes, fixed income and equities. And then I'll turn it over to John, who will do a deeper dive into the macro reasons for what we are seeing in the financial markets. So this particular slide, we are looking at the fixed income markets re-rating of emerging markets. On the left-hand side, the two charts on the left-hand side, we are looking at what's happening in the sovereign bond space. So the top left chart, what it is showing you is the emerging market sovereign 7 to 10-year long bonds minus the various developed market 7 to 10-year yields. And this data starts end of 2021. Why? Because remember, March 2022 is when the Fed started hiking rates. That's the time when early 2022, when inflation was a concern and most DMs were raising their rates. And what do you see? We see that the emerging market sovereign spreads relative to the DM sovereign spreads actually started compressing. In fact, if you see the dark blue and the light blue lines, their spreads relative to UK and United States drop so sharply and are right now in negative territory. Remember, we grew up learning that when the Fed raises rates, emerging markets go into distress. This is anything but. And the reverse of these sovereign bond yields shows up in the price returns, just bond math. So on the bottom left, what you see is for the 2024 US dollar returns, emerging market government bond index had higher returns than the world government bond index. Emerging markets were in positive territory around plus 2%, whereas the world government bond index was about minus 3%. Now, on the right-hand side, the two charts that you see is the repricing in the credit markets. So the top chart shows in the high yield space, the bottom chart shows in the investment grade space, and you see the credit spreads all relative to US long yields. The spreads in US, in Europe, and in emerging markets, and emerging markets is the gray line. So see that traditionally, historically, the emerging market spreads were far higher than in US and Europe. But see the sharp compression in recent years, and that's what you see. The gray line is kind of almost converging just above what it is for Europe and US. In fact, in the investment grade area, EM spreads are just about 22 basis points higher than Europe. In high yield, they are just about 30 basis points higher than Europe. And these are all data as of end December 2024. Let's turn gear and look at what's happening in the equity markets. So the first thing I want to say is there is a catch-up story. Now, we all know US has been a really strong outperformer in equity markets. Nobody is questioning that. It's only the catch-up story. The difference is kind of compressing between emerging markets and US. Why do I say that? The top left chart basically gives the absolute returns in the two eras as I look at regimes, really. The GFC to COVID era in purple and the gray in 2024 returns. And a more interesting way of looking at that is the bottom left chart where I've highlighted, and we are showing emerging market returns as a ratio of the US equity returns. So emerging markets returned just about 24% of US returns on average during the GFC to COVID era. But 2024, emerging markets returned 51% of the US returns. So that's what I mean by playing catch up. As a percentage of US returns, they have really played catch up. And a lot of it has to do with the valuation story. So on the right hand side bottom, you see that the EM valuations have really increased. Their forward Ps, they are now at about their 5-year average. And on the top right, you see the current valuations, the blue bars, that in emerging markets, they have now reached their 10-year average. In most parts of the world, it's still just below their 10-year average. United States is, of course, an outlier with current valuations being at 10-year max levels. And one more thing, this was on the return side. It's very important to also look at the volatility, the risk side. That's the chart on the left-hand side. EM market volatility versus DM markets, and everything is through FTSE Russell indices. And you see that the two have really converged. Emerging market equity volatility is in line, has converged with that of developed markets. In fact, I know 1 month is a very short data point, but in December, EM vol was actually lower than DM vol. And with that, let me turn it over to John.
Thank you very much, Indrani. And yes, there is definitely a positive story in the emerging markets. And then one of the reasons really is it's probably that the emerging markets have learned how to deal with inflation and high inflation environments a lot better than what the developed markets have, especially in the last, say, 10 years, 15 years. And what you see here is I've basically picked two emerging markets to look at. The first one we're looking at is India, which is pretty much the leading economy of the BRICS. And the second one on the next slide will be Indonesia, the leading economy sort of the ASEAN countries. And the reason why I've gone with these two countries is because really the growth area in the next 15 to 20 years in the global markets will be the Asia Pacific area. And whilst India is on sort of just next to that, it is currently one of the growth markets in the world. And what we see with India is, in terms of the rate of consumer inflation, is that it's not normally tracks on average between 8% as a maximum and 4% as a minimum. And it's currently tracking at 5.22%, which is heading very close towards the Reserve Bank of India's 4.5% in terms of its inflation target. So the Indian consumer inflation is under control, right? And then on the right-hand side, we look at Indian industrial production on a year-on-year basis, and we see that it's currently tracking at 5.2%, which is very strong. So what you have is an economy with room to grow. It's not overheating. The inflation story tells us that, and where manufacturing is very strong. When we go to Indonesia, probably the leading ASEAN economy in terms of performance, but also in terms of, I believe, one of the largest populations, if not the largest. When we look at the Indonesian consumer confidence, it's very high. It's very strong, certainly from where it was at the start of the 2000s, where they were still dealing with a bit of a hangover from the Asian financial crisis. But we know that the Indonesian consumer is a positive story. So there's definitely stocks that you probably want to invest in there that are consumer driven. And we also look at the unemployment rate, and we see that it's very, very low relative to where it's been for the last 20 years. I mean, it's at its lowest point in terms of when it peaked in just after sort of 2005, 2006. So we can see that Indonesia as well, as an ASEAN nation, is a compelling story and probably a very good destination for foreign investment, given these two macro indicators. In summary, the macro data, perhaps not in all emerging markets, but in very, very specific emerging markets, is very, very strong and backs up Indrani's hypothesis. Thank you very much, everyone.
Thank you. And that closes today's episode. Thank you for joining.